Crypto investors are getting worried after Bitcoin and the rest of the altcoin market have tumbled toward the downside over the last few days. In a month that was previously dubbed October, we're stuck wondering what went wrong. In today's video, I'm going to break down why are we seeing this crypto dip? Should we be worried? And when can we expect a reversal? If you're excited to learn more, like and subscribe down below, and let's find out just what is going wrong. Now guys, I hear your concern. October is supposed to be one of the best months in crypto and we're seeing a sharp dip to the downside. What could possibly be the cause for that? Well, first let's have a look on your screen. October is supposed to be the third best month of the year. Average Bitcoin return in October is supposed to be around 30%, only beat by April and November, which are close to 40%. So we're seeing a pretty solid dip. We saw Bitcoin go above 125,000, and then it dipped below 120,000, and now we're kind of just ranging around 121. So what went wrong? Why are we dipping right now? Well, guys, it has to do with liquidity. And on this channel, we talk about liquidity a lot. And you can see here on your screen, Bitcoin and global liquidity connection. I think most of you are familiar with this at this point. We've got a strong connection and we're seeing global M2 rising. Why isn't Bitcoin rising? Well, guys, there has been a development lately and it's something that we've talked about kind of in passing on this channel. We're going to dive into it a lot more today, and that is the TGA rebuild. The TGA stands for the Treasury General Account. Now, what happens is that when the government debt limit is reached, they have to fund the government from their piggy bank. So they pull money out of their piggy bank, they put it into markets, they put it into the financial system. This is a boost of liquidity. And you can see that here on this chart. You can see the US Treasury cash balance. As the cash balance goes down here, you can see this right here, the S&P goes higher because they're pulling money out of their piggy bank and they're putting it into markets. They're putting it into the financial system to fund the government. This is an injection of liquidity. Good for markets, good for Bitcoin, good for crypto. But when the debt ceiling gets passed and they say, okay, now we can issue more debt, they have to refill that piggy bank. You know, that money doesn't just come from nowhere. So they have to pull money out of financial systems, out of markets, and put it back into the piggy bank. And you can see that right here. You can see as the US Treasury cash balance goes higher, as the piggy bank gets refilled, you see the S&P go down. And you can see several instances of this. Now, you can see right here, this on the right-hand side here, this circled area, this is where we are now. And this is the US Treasury cash balance going from 515 billion up to 850 billion. That is basically $335 billion taken out of markets. Now, the problem is that this is obviously a major drain on liquidity. It's a third of $1 trillion. Markets are responding primarily to liquidity right now because the real economy is kind of stagnant. The business cycle is flat. We've talked about that on this channel. And so markets really only have liquidity to respond to. Listen to this clip from Mike Howell. He's going to break this down so you can understand it. Listen to what he has to say.
And the interesting point is, which I'm sure you'll attest, is that, financial markets are responded not to the real economy, they're responded to the liquidity cycle. That's what's going on. So we need to understand this, like it or not. I mean, it's become the paramount issue in markets as far as we can see.
And so this is now the paramount issue in markets. So let me show you this chart. This is showing the liquidity dynamics in the United States. This black line here is the Fed balance sheet. And we can see that this has been trending down. Not only are we rebuilding the Treasury General Account, but the Fed is actually in quantitative tightening. And we did a video on this a few days ago, but what that means essentially is the Fed is pulling money out of the system. It's a drain on liquidity. And so not only are they pulling money out of the system to refill their piggy bank, but they're also just dumping liquidity out of markets kind of just passively in the background. They've been doing this for years. And so have a look here. You've got this blue right here. That is the Treasury cash at the Fed, TGA. And so that shows us that this is going higher. Now, this orange bit right here, this is the reverse repo. And basically what this is an overnight lending program. So basically, if I'm a private bank and I have a couple $100 billion and I want to get a quick return on it, get an overnight return, 1%, 0.5%, whatever, I will park it at the Fed. They will give me that money the next day and I'll take it back. This is typically where they would draw this from. They would draw the TGA rebuild from the reverse repo pile. It's kind of a pile of cash they have sitting at the Fed. As you can see, we have basically none left. The reverse repo is completely empty. And so where do they have left to draw this money from to fill their piggy bank? They have to pull it out of financial markets. This blue bit right here has to come from somewhere. This is their Treasury General Account. It's not coming from this orange bit right here. So where's it got to come from? It has to come from markets. And when there's a dip in liquidity, taking us back to this chart here, you can see that dips in liquidity equate to a dip in Bitcoin price. It's not a direct one-to-one correlation, but it is very close. It is a very close connection. And when you're talking about hundreds of billions of dollars, and so you can see it on this chart here as well. This is, again, just another way of looking at it. Overall liquidity from the Fed. You've got overall liquidity. This is the Fed's balance sheet here. And then this is CRB, Raw Industrials Index. It's basically just like a commodities index, stocks, risk assets, essentially. And as one goes down, the other goes down. And so this is the equation for liquidity. SOMA, which is basically the Fed's balance sheet, minus the TGA, minus the reverse repo, okay? So we're taking the amount of cash that the Fed has, and we're subtracting the reverse repo and the Treasury General account from that. So let's go back to this chart and have a look. We're subtracting this from that, and this is getting higher. So the number that we're subtracting away from the Fed's balance sheet is getting higher. So we're reducing the Fed's balance sheet more and more, which means that this purple line is going to continue to go down. Bitcoin is going to continue to go down. And so this actually makes sense to me why this is happening right now. This makes perfect sense. This is exactly kind of where we should be. Now, in terms of the future, I don't know how long this is going to last, to be honest with you. I'm not sure if they're going to rebuild it all the way to this 850, because that would be a pretty severe damper on markets. And if they do that, we need to be ready for that pain. We need to be ready for it. But after this, nothing that I can see tells me that there is going to be a further drain on liquidity. This really seems to be the final hurdle in terms of liquidity. So this is what we're dealing with right now. And this is something we just have to accept. That being said, let's look ahead to the future and see what good news we have. On this channel, I've told you that liquidity is coming, and it is. So let's have a look here. Let's have a look at the U.S. Fed and U.S. Treasury all stimulus. This area in gray here, this is what's forecasted to come. And you can see that this is the bull market right here, just to give you an idea of how this works. This is massive liquidity coming into markets. This is the COVID money printing absolute fiasco. It shows you you can see the connection. And this is the bear market right here. They're pulling money out of the markets. Remember at the end of 2023, when we had that, basically the closest thing we've had to a bull run yet. We ran all the way up basically from October, November through to the beginning of 2024. That was this right here. That was this injection of liquidity right here. So now we're starting to come back up. We have a little dip right here if you really want to zoom in. But really the trend is your friend here. So you wanted to zoom out and look at the big picture. And the big picture is a lot more stimulus. The big picture is a lot more stimulus. And they have to do this. Why? Look at the change in federal debt. Look at how much debt we have to handle. And look at the change in the Fed's balance sheet. Central banks are the ones that have to deal with this problem. We've mentioned on this channel they're passing it along to private banks. The Treasury is issuing short-term debt, and the private banks are buying that up using private credit. But eventually the central banks, I believe, are going to have to step in, because that's what central banks are designed to do. And you can see that historically, really for the last 2.5 years on this chart, you can see that the Fed has typically stayed even with the change in federal debt because they were the ones handling it. Now we've seen a sharp divergence. So this is all debt that needs to get handled, and they have to inject liquidity to do that. So one way or another, this debt's got to get settled. Good for us because that's more liquidity into the system. Now, in terms of liquidity, there are two main pillars of liquidity. It's the West and the East. The West is led by the US, the East is led by China. We did a video the other day on the stimulus, the liquidity coming from China. China is dual-wielding bazookas right now and blasting liquidity everywhere. So just because the Fed is lowering their liquidity right now doesn't necessarily mean it's all bad. In the future, they will have to add more, but right now what's happening is China is getting ready to absolutely send it on liquidity, and you can see that here. And so this is a chart. This is forecasting the liquidity coming from the Chinese central bank, and you can see the connection to world commodity prices. So we're forecasted to go much, much higher in terms of liquidity. And so now we're looking ahead. We've got the bad news out of the way. The TGA is getting rebuilt. Yes, we can't do anything about that. So we have to just be patient and look ahead to the future. And I think that's really what the power of macro is zooming out and understanding what's coming. And so this is a lot of money coming. And let me show it to you a different way. Is the Chinese credit cycle and its impact on commodities coming back? And so you can see that here in blue is the Bloomberg Commodity Index, essentially risk assets. And then China bond issuance, that's basically treasury debt, government debt, way higher. Way, way, way higher. We're going up and to the right. There is a surge of liquidity coming from markets. And this is what I want to emphasize to you, that this dip that we're in right now, it might feel painful. I know we're supposed to be in October. And typically, again, if you look at this chart here, again, it shows you that October is typically very, very good. Since 2013, we have only had 2 negative months for Bitcoin. And again, we're still early in the month. I mean, this is just a little bit of a pullback, and I'm making this video because I want people to remain calm. Macro gives us the conviction we need to sit comfortably through volatility. And if we can zoom out and understand that October is typically a green month, we're still early in the month, we understand why the dip is happening. It's not because it's over. It's not because this time's different or because the bull market already happened and we're all going to zero now. It's because of this right here. It's because we are seeing $335 billion of liquidity get pulled out of markets. Raul Paul is keen to this too, and he's obviously one of our crypto gurus. We all look to him for comfort and advice. So listen to what he has to say on this. I think you'll be... He basically feels the exact same way. Have a listen.
Yeah, everyone's getting really caught up on this because they're like, the reverse repo is empty, and therefore, if you rebuild a TGA, you've got a massive liquidity shock.
There it is. So a short clip, short and sweet. Everyone's freaking out because the reverse repo is empty. It's just down to zero. And you have to rebuild the TGA here in blue. You're going to get a massive liquidity shock. But looking forward, we're looking really good, guys. Again, like I said, China's printing. The Fed has tremendous amount of debt they have to refinance. Commodities are probably going to go much, much higher. You could say Bitcoin's a commodity. It's a risk asset. Either way, we're looking good here. Liquidity is good for Bitcoin. And so that's what we've got. You've got a TGA rebuild happening at a time when there's little or no money sitting at the Fed that they can pull from. They have to pull it out of financial markets, and so they're drawing the markets down. This is normal. This is how it's supposed to happen. Nothing's different. Nothing's changed. We're still on path, I think, for a very solid next, let's call it 6 to 8 months. I think we're going to go into Q1, Q2 of 2026. Keep an eye out for a video on that this week or next. We're going to break down why I think this time's different and why you should be so bullish going into 2026. And on this channel, that's our goal, is to keep you bullish. Not because we're delusional, but because that's what the data is telling us. And when the data tells us to get bearish, I will be here telling you that as well. I want to stay real with you. And right now, being real with you means telling you that there's nothing to worry about. And so if you want to remain comforted as we move through this bull cycle, make sure you like and subscribe down below. Leave us a comment. Let me know if you've learned anything. As always, thank you for being here. We'll see you in the next video. Stay confident.